Pantheon AI presents oil surges on Israel-Iran tension, warning 1,000 new U.S. millionaires daily. Good morning, everyone. Welcome to the PAI Morning Briefing. I'm John from PantheonAI, and it is June 19th, 2025. I hope you're all set with your coffee and a curious mind, because we've certainly got plenty to unpack today, don't we, Sarah?
Absolutely, John. There's never a dull moment in the markets, and today is no exception. It feels like a real mixed bag out there, actually. Let's just dive right into the market overview, shall we?
Sounds good. Kicking things off, the S&P 500 is trading around 5,980.87, showing a slight dip of about minus 0.117%. Over on the Dow Jones Industrial Average, we're seeing a reading near 42,171.66, also with a modest decline of roughly minus 0.152%.
Right, so a bit of red on those fronts. But then you look at the Nasdaq, and it's actually holding strong at around 19,546.27, inching up by nearly 0.099%. And for the small caps, the Russell 2000 is sitting comfortably at a little over 2,112.96, rising by approximately 0.552%. So definitely a bit of a split personality today, wouldn't you say?
Totally. It's like a tug of war between that risk-on and risk-off sentiment we often talk about. And speaking of mixed bags, let's swing over to the crypto corner. Bitcoin is trading around $103,962.42, taking a slight hit with a decrease near 0.9%. Ethereum isn't far behind, showing a trading price of roughly $2,486.36, down about 1.536%.
So crypto's feeling that slight downturn too. It really does underscore that mixed bag theme, doesn't it? Traditional equities seeing minor losses, but then some indices still maintaining momentum, and tech-driven Nasdaq pushing forward. It's never simple, is it?
Never. But let's dive a bit deeper into some of the major market trends swirling around. And, one of the dominant themes this morning has to be the energy market. Oil prices have been on the move, rising by more than 1%. This comes right after news that Prime Minister Benjamin Netanyahu has given a clear directive to intensify attacks against Iran.
Oh, that's significant. Geopolitical tensions like that always have a pretty direct impact on oil prices, and the market's definitely reacting accordingly. It really puts energy stocks in the spotlight, and it makes you think about portfolio balancing, doesn't it? Are you too heavy in cyclical energy plays, or are you diversified enough?
Exactly. This escalation in Middle Eastern tensions brings a real mix of anxiety and opportunity. On one hand, heightened conflict risks can definitely increase market volatility. But on the other, energy companies could benefit from that upward pressure on crude oil prices, which then has a cascading effect on related stocks.
It's a classic dilemma. It leaves us wondering, will this escalation continue to support energy equities, or could emerging market uncertainties soon spill over into broader risk markets? That's certainly a question worth pondering as we look at our positions, especially for those long-term investors.
For sure. Beyond energy, we've got several other significant developments that could influence investor sentiment. For instance, Bank of Montreal is making headlines by acquiring a Toronto-based wealth manager, Burgundy, for roughly $625 million. This is a clear sign of how financial institutions are really bolstering their wealth management capabilities.
Right? With more affluent clients and a strong desire to diversify revenue streams, banks are really positioning themselves to take advantage of evolving market dynamics, especially in a low interest rate environment. It's interesting how they're not just growing organically, but looking at strategic acquisitions to reinforce their market position. You could almost say this bank is on a shopping spree, but I hope they've got their accountant on speed dial for that one.
Good point. And speaking of strategic moves, VitalHub recently completed its acquisition of Induction Healthcare Group through a cash deal. This really highlights the ongoing consolidation trend within the healthcare sector, where companies are aiming to create integrated service platforms.
Yes, to tackle those dual challenges of rising costs and technological disruption in care delivery. The healthcare industry is just constantly evolving, and acquisitions like these are big indicators that we might soon see more comprehensive service offerings. It could definitely strengthen both the balance sheets of these companies and their competitive positions.
Absolutely. Another important development comes from Mandalay Resources Corporation. They've announced they've received Swedish regulatory approval for a proposed merger. This is intended to form a partnership of equals and is in line with earlier communications.
It's always fascinating to see how cross-border regulatory approvals can really shape the narrative for mergers and acquisitions. When companies secure these kinds of approvals, it often signals to the market that broader, more integrated operations are on the horizon. Mandalay's progress here could really set the stage for a more robust presence in its industry. And, it's a signal for potential investor interest in mining or resource companies, depending on how these consolidation strategies play out.
Yeah, it definitely is. Now let's turn our attention to a particularly fascinating statistic from the United States. A recent study by UBS has revealed that the country added approximately 1,000 new millionaires every single day in 2024.
Wow! 1,000 new millionaires a day? That's incredible! That brings the total number of millionaires in the United States to 23.8 million. That figure really underscores the dynamic nature of wealth creation here. While some might joke that money makes the world go round, statistics like these have a profound impact on consumer confidence, wealth management strategies, and even spending patterns.
Right? The fact that these numbers are growing so rapidly suggests that economic opportunity is expanding for many individuals, even if the market conditions seem a bit choppy on a day-to-day basis.
It's a really interesting juxtaposition, isn't it? On one hand, you have volatility, and on the other, this massive wealth creation. And then, shifting gears to Europe, a Reuters report notes that officials within the European Union are increasingly resigned to a baseline tariff of 10%.
That's a pretty significant shift in trade policy. It could have major implications for transatlantic trade and global supply chains. It's a subtle yet important indicator of how trade negotiations and regulatory policies are evolving, potentially affecting everything from automotive exports to advanced technology components.
For investors, it presents both a cautionary tale and an opportunity, I think. You have to explore sectors that might benefit from these policy adjustments. As trade barriers adjust, companies that can navigate the regulatory environment effectively may well find themselves as winners in this new landscape.
Definitely. And while each of these individual stories holds its own weight, when we step back and look at the broader canvas, we can really see several underlying themes at play. One is the role of geopolitical tension, which continues to do more than just rock the energy markets. It influences corporate decisions, regulatory policies, and even market sentiment among retail and institutional investors alike.
That's a great point. Secondly, we're seeing this strong trend of strategic consolidation in sectors like finance and healthcare, which is likely driven by a confluence of technological innovation and an increasingly competitive landscape. And then lastly, the increasing number of wealthy individuals in the United States speaks to a broader economic strength that is, perhaps paradoxically, juxtaposed against moments of volatility in the market.
Exactly. Let's take a few moments to look at these trends through the lens of detailed sector analyses, starting with the technology sector. Despite being somewhat insulated from the direct energy and geopolitical news, technological innovation is the backbone of so many industries and even broader macroeconomic shifts. The Nasdaq's slight uptick today is a reminder that even with broader market headwinds, tech companies often find ways to innovate and keep their momentum.
It's true. Technology continues to be the engine that drives everything from our personal devices to complex systems within healthcare and finance. It makes you wonder whether the next wave of technological breakthroughs might even emanate from companies that are in the midst of consolidations or acquisitions, much like what we've seen with VitalHub and Bank of Montreal. Maybe this signals a convergence between traditional industries and rapidly emerging tech players, adding an extra layer of complexity and opportunity for investors.
That's a really insightful thought, Sarah. Shifting gears to the energy sector, the news in this area has been pretty bold. Oil prices are getting a lift following the announcement that Israel is ramping up its military stance against Iran. It's a story that goes far beyond just crude oil numbers, right? It touches on international diplomacy, investor confidence, and even consumer prices at the pump.
Absolutely. Energy stocks could see increased volatility as geopolitical risks translate into market risk premiums. Companies in the oil and gas sector may even see higher valuation multiples if the risk is priced appropriately. But there's always that counterbalance to consider. Increased energy prices can lead, over time, to reduced industrial demand or even spur interest in alternative energy sources.
It's a classic market conundrum. Will investors continue to pump money into fossil fuels, or is this a sign that a transition to cleaner energy sources is inevitable? As ever, market conditions are like a well-mixed cocktail. Sometimes you get a blend that's delightful, and sometimes a strong kick that leaves you rethinking your strategy.
That's a perfect analogy, John. The finance sector is also under the microscope today, and the acquisition of Burgundy by Bank of Montreal is a prime example of how financial institutions are continually evolving to stay ahead. In today's rapidly digitizing economy, wealth management isn't just about traditional banking, is it? It involves high-tech data analytics, personalized advisory, and even AI to provide a more tailored experience to clients.
Right. With technology reshaping the landscape of finance, acquisitions like these are a really strategic move for banks looking to diversify and solidify their foothold in a competitive market. And if you're thinking that mergers and acquisitions are only for Wall Street giants, think again. Even the smaller players are engaging in similar strategies. And that adds another dynamic that savvy investors really need to watch closely.
That's a great point. And of course, our conversation isn't complete without looking at the healthcare sector. The consolidation activities we're witnessing, like VitalHub's acquisition of Induction Healthcare Group, speak volumes about the changing face of healthcare delivery. With ongoing pressures like rising operational costs and the constant push for innovation in medical services, companies are forced to reevaluate their business models.
The end goal seems to be the establishment of more integrated, efficient, and patient-centric systems that can thrive in a competitive environment. It may not sound as flashy as a roller coaster ride in energy stocks, but for investors with an eye on long-term stability, healthcare remains one of those essential sectors that underpins the overall performance of an investment portfolio.
And if consolidations here lead to more streamlined processes and better patient services, then that's a win for everyone, right? Patients, providers, and, yes, even the shareholders. Now, as we pull back to see the bigger picture, the interplay of global market implications becomes really evident. The shifting dynamics in trade policy, as highlighted by the European Union's movement towards that 10% baseline tariff, could ripple across international markets.
Yeah, affecting everything from supply chain costs to consumer prices in major economies. Global market participants need to be constantly aware of such trends because they have a direct correlation with exchange rates, commodity prices, and even cross-border investment flows. Imagine a scenario where rising tariffs lead to cost pressures on multinational companies. That scenario could ultimately curtail profit margins and lead to a rebalancing of portfolios across various regions.
It's a powerful reminder that in today's interconnected world, a policy decision in one corner of the globe can truly reverberate across continents. Now let's bring in some expert insights and predictions. Over the past few years, market volatility has become almost a daily affair, a fact that keeps investors both on their toes and reaching for their calculators.
Looking ahead, you could argue that with the current geopolitical tensions, energy stocks might continue to perform well, at least in the short to medium term. However, the possibility of a broader market correction definitely shouldn't be ruled out, especially if global events tip the scales in favor of risk aversion.
And the technology sector, as usual, is poised to remain a key driver of market performance. With everything from cloud computing to artificial intelligence gaining traction, companies within this space might continue to deliver impressive growth numbers, even when other sectors are battling headwinds. And in finance, we might see banks doubling down on digital transformation initiatives as they seek to combine traditional management with next-generation technology tools. It's an exciting time to be an investor if you're savvy enough to pick out the trends that matter, I think.
I must admit, sometimes I find the intersection of these trends a bit like trying to solve a jigsaw puzzle while riding a unicycle. One moment you're laughing at the quirky idea that even banks are now on a spending spree. After all, who knew bankers loved a good shopping trip? And in the next, you're questioning whether the uptick in millionaire numbers truly indicates a broad-based economic boom, or if it's just a reflection of elite wealth gaining momentum.
That's so true. It even challenges our conventional ideas about economic inequality and the long-term prospects of the middle class, doesn't it? Which brings me to a crucial point for our listeners. How do we navigate such a labyrinth of information in today's market? It really requires a balanced approach, a keen eye for both macroeconomic indicators and micro-level corporate developments, and, above all, a healthy sense of curiosity.
Absolutely. As investors, we're all tasked with asking the hard questions. When is the right time to jump into a new sector? How do you balance short-term market volatility with long-term growth objectives? And in a world where 1,000 new millionaires are being made every day, what does that mean for your personal portfolio strategy?
These are big questions, and there are no easy answers, but they really highlight the importance of staying informed, asking the right questions, and continuously reassessing your strategy in this dynamic market environment. Now, let's take a moment to recap our discussion. We started off with a quick overview of the major indices and cryptocurrencies, noting that while the S&P 500 and Dow Jones saw slight declines, the Nasdaq and Russell 2000 actually provided a glimmer of optimism.
Right. We then explored the significant market trends, from rising oil prices due to renewed geopolitical tensions in the Middle East, to major strategic moves in the finance and healthcare sectors through acquisitions. We also touched on global policies, like the EU's move towards a 10% baseline tariff, and that remarkable growth in the population of millionaires in the United States. Each of these elements paints a picture of a market in constant flux, one that is responsive to both political signals and corporate actions.
And when we drill down to sector-specific analysis, the interplay between technology, energy, finance, and healthcare really reveals that diversification is more than just a buzzword. It's a necessary strategy that can help hedge against the uncertainties that come from any one area or geopolitical event. For instance, while energy stocks might provide an immediate rally in the wake of rising oil prices, technology and finance might offer more resilience over the longer term due to their capacity for innovation and adaptation.
Precisely. And as the global trade environment continues to evolve, international diversification might offer additional buffers against regional economic shocks. For those of you who enjoy a good dose of humor with your market analysis, let me leave you with this thought. Sometimes following the market can feel like playing a game of chess against a savvy opponent who just happens to cheat with insider information.
That's a good one. But remember, even in the midst of uncertainty, careful analysis and disciplined investment strategies tend to pay off. And if you ever find yourself scratching your head wondering if you missed a move, just remember that every investor has been there, pondering whether the next news flash might be the twist that turns the whole game on its head.
So true. In terms of expert predictions, many in the industry suggest that we could see further volatility in the days to come. The continued military actions in the Middle East might keep the energy sector on its toes, while the evolution of digital finance and tech innovation could provide pockets of growth despite overall market uncertainty. It's a landscape where adaptability and speed of reaction are more important than ever. This might be a good time for portfolio reviews, actually.
Definitely. Are you exposed enough to sectors like tech and finance that can weather geopolitical storms? Or are you too heavily invested in areas that might face headwinds if tensions escalate further? On the global front, it will be interesting to monitor how policies in Europe and shifts in international trade dynamics shape the market sentiment in the upcoming quarters. And as the United States continues to add new millionaires at an astonishing rate, there's a chance that consumer trends and spending patterns might shift, influencing sectors like retail and real estate.
And let's not forget the potential knock-on effects on emerging markets if there is a correction in wealth distribution, or if trade barriers begin to weigh more heavily on profit margins. Before we wrap up today's briefing, I'd like to leave you with a few thought-provoking questions. How might the intensification of geopolitical tensions in the Middle East influence not only the energy sector, but also industries that are indirectly connected, such as manufacturing and transportation?
And with Bank of Montreal's strategic acquisition, is this a harbinger of more consolidation in the financial sector? And should investors expect similar moves from other banking giants? And finally, given the rapid increase in the number of millionaires in the United States, what does this mean for the overall consumer landscape and the potential for even more innovative business models to emerge?
These are big questions, and while there are no easy answers, they highlight the importance of staying informed, asking the right questions, and continuously reassessing one's strategy in a dynamic market environment. I encourage you to take these questions to heart, discuss them with your financial advisors, or even bring them into your next boardroom meeting or friendly debate over dinner.
That's a great idea, John. So as we draw our conversation to a close today, let's quickly recap our key takeaways. First, The mixed performance in the equities market, from slight declines in major indexes like the S&P 500 and Dow Jones to modest gains in the Nasdaq and Russell 2000, reflects nuance in today's trading environment.
Second, ever-evolving geopolitical tensions in the Middle East are having a palpable effect on the energy markets, reinforcing the need for investors to remain vigilant about global political events. Third, significant corporate acquisitions in both finance and healthcare, including actions by Bank of Montreal and VitalHub, indicate that consolidation continues to be a dominant strategic tool in adapting to today's competitive landscape.
And finally, global trade policies, particularly in Europe, coupled with an unprecedented rise in America's millionaire population, really underscore the multifaceted nature of market evolution in our interconnected world. We really want to give a special shout out to PantheonAI, your information co-pilot, for helping us navigate these complex market trends and bringing together diverse strands of news for such a comprehensive look at the day.
It's a fantastic tool. As we part ways today, I encourage each of you to reflect on these insights and consider how they might impact your own investment strategies. And before we sign off, I'd like to leave you with one last thought. Learning shouldn't feel like a full-time job. Instead, let it be an adventure, a journey of discovery, where each news story, each market move is a clue in the grand puzzle of understanding our world.
Exactly. And as always, if you have any questions or need a deeper dive into any topic we covered, remember that you can always ask questions to our AI co-pilot. Thank you for joining us on this morning's briefing. Make sure to come back for the next episode tomorrow as we continue to untangle market trends and bring you the latest insights.
Until then, stay curious, stay informed, and keep questioning the status quo. Have a great day and happy investing.
Pantheon AI, your information co-pilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.